Intellectual property is a central part of our strategy. Within our team, we have experience in creating value just out of IP as an asset class, so to speak. Having a strong patent portfolio to negotiate against a big company. Strong patent portfolios in an exit is critical and central, because then when it gets into the big guys' hands, then they can really be of some value. You know, in my days in the private equity world, in the larger scale at the time, and in the small to mid-sized scale, you went into it with generally some understanding of who's going to want to buy it. These days, it's more I generate cash flow, another PE firm's going to buy that cash flow. You never know where it's going to end up. You know who the strategics are that if this works, they're going to have a big interest in it.
Welcome to the Raise and Exit podcast, where we're going to be sharing with you wisdom from people who've been through transactions, have been through buy side, sell side, and have gone through the successes and the trials and tribulations that are there. So this is, of course, oriented towards founders that are looking to raise, seek investment, or have a successful exit for their business. Today, we have a very special guest with Kurt Buseck, and he's going to be bringing us some interesting experience because he's been with giant organizations in going and making due diligence and acquisitions, but he's also gone and made direct investments and acquisitions himself, and he now runs a deep tech fund, and that is a rare mix in the market of investors that is there. So on that note, Kurt, welcome to Raise and Exit. I'd love to just have you introduce yourselves a little bit more, share a bit of that past wisdom before we dive into some of the questions that are relevant to viewers and listeners of the show.
Thank you, Edgar, and thank you for having me here. So I'm managing partner at Rex Capital. As Edgar said, we're a deep tech focused investment firm. We view we're a little differentiated from most investment firms that, number one, the focus on deep tech. There's 15 of us. We have a lot of operational experience. I'm finance background, as I'll mention in a second, but most of my colleagues are operationally oriented, starting, building, working for large tech companies. A lot of expertise in semiconductors, electronics, chemistry, materials, things like that. We're also very operationally focused. When we make an investment, we don't become part of management, but we are much more involved than a board director, getting really deep into the operational scaling issues, the financial strategy of the business, the go-to-market model, things like that. And we're also not afraid to look at a complex situation, some dysfunctional existing shareholder bases, things like that. My background, I've sort of had two phases of my career. I was in the PE world for about half my career on Wall Street with the largest PE firm based out of Canada. I ran their New York office, and then they sponsored me to set up my own firm. And I moved back to Pennsylvania, where I'm now located, where I was born and raised, and did smaller, mid-sized buyouts, acquired 14 companies and sold them, and then took some time off doing civic work. And as part of the civic work, I was intrigued with the impact of early stage companies on economies and how to rebuild economies, et cetera. And that got me investing into a number of early stage companies. Some worked, some didn't. But I got to know people out in Silicon Valley, and particularly at the Stanford Research Institute, which is I think the largest standalone research organization in the country, about 1,500 PhDs. And they asked me to get involved in helping resurrect some of their spin-outs that had not worked. And that got me into the deep tech sector. And through that, in essence, the strategy for Rex was developed. We started Rex last year, so we're a new firm, and that's how I got here.
That's amazing, Kurt. I love the kind of dynamic that is there between being involved with a large PE acquisition firm, and then you've almost kind of gone the other way, right? Instead of starting small and gone big, you've started big and you've gone small. Can you tell me a little bit of what you see are the commonalities that you've run across in making investments or acquisitions that are just almost, call them universal truths in transactions that you've seen founders should be aware of and has been a hindrance for you in the past? Like I really wish they knew this when they tried to sell their company or they tried to go and get an investment.
I don't know if I'm going to answer that last question, but the commonalities, I think, and I haven't considered this on the spot, I would say that as most investors would say, the management is the key. Not only the technical capability, the breadth of their background and experience, the documentation of the proof of what they're trying to do, that they've done it before, but also that intangible of the character of the people. Things that have taken a lot of my time that have been experiences where things did not work so well. It usually was not the capability of the people, but the character of the people. So kind of that intangible, and finding ways of trying to document and measure that. The early stage side of things and the later stage deals I was involved in, obviously there's a predictability of cash flow, there's a predictability of near-term, medium-term outlooks for the business. You're kind of gauging if you're going to be able to tweak that to accelerate growth and things like that. I'm always amazed in the early stage, the focus on founders is on the technology, the product market fit, as it should be, but not as much fit on what really are the capital requirements of the company in a broader sense. Some are really focused on the P&L and not the other dynamics that impact cash usage. So it's a pretty obvious perspective when you're raising capital and what are my uses of funds, et cetera, but there is generally a lack of sophistication and understanding, what really if the assumptions are met, what the cash needs of the business is going to be, what the outcomes are, et cetera. My limited experience has indicated that that's generally not as potentially as sophisticated as it should be. Mm-hmm. I think most companies are obviously looking for huge markets to go after. Really focusing in on precisely which markets are going to have an interest in your product. Also, that's kind of a make or break in decisions on whether or not to invest, not just broad brush, huge markets, but with much more specificity in what they might be able to serve. Those are just some comments that come to the top of mind.
That's actually very valuable, because I think what you're pointing to is, especially in the deep tech arena, you usually do not have people with a strong finance background going and launching deep tech companies. They're frequently researchers.
And I've only, I was involved in other early stage companies, and it's sort of across the board. And again, I've got limited experience, so I may be wrong, but it's more across the board.
Okay, that's helpful. Can you give me a little bit of insight of what might be different from the timelines that people need to consider in deep tech investment? And this could be for a founder that is looking to raise, how they manage expectations, but also as an investor. What are the timelines you're typically considering?
So maybe just to put in context what we're doing. So one of the aspects of what was the background of Rex, and this ties directly into your question.
Thank you.
Is that although there's not a lot of statistics on this, anecdotes would indicate that in a typical venture portfolio of, say, 100 companies, 100 just to make the numbers easy, that maybe 10 are home runs and drive returns out of the park.
Yeah.
Maybe 20 or 30 just don't work, even though every single one was, when they made the investment, there was an expectation they could become a unicorn. But maybe, so every single one, they wouldn't have made the investment unless they had that belief.
Yes.
But maybe 20 or 30 just don't work. And the more our experience indicates, our contacts and networks would indicate that the more a venture firm is successful in having a good number of unicorns, companies that are driving returns, ironically, they leave more and more companies in the middle that they're not spending a lot of time on, and they're not putting more capital in, et cetera, because it's in their investors' best interest that they focus all their time on those big winners. And that the part of the background of Rex was this kind of middle ground of companies that are stalled. They didn't hit maybe a particular milestone. The earlier investors can't put any more money in. The next round, the BEC or whatever, is not ready to put money in because they haven't hit the milestones and they're just stalled. And if it's an app or something like that, well, the founders, that's too bad. They go next door, they can start it over. For deep tech companies, so we think there's a bit of a void in the market for trying to address these stalled companies. when they have great technologies, great market capabilities, and they deserve to be serving society. When it's a deep tech company, it might have taken 10 to 15 years to get to that point.
To get to the point where you're investing, or to
Well,
get to
yeah,
that
yeah, to
market
get
impact?
to the point that I'm describing.
Right. Okay.
Because maybe there was 5 years in a research university or SBIR grants or et cetera, and 5 years with some seed capital, and 5 years with, Series A investment, et cetera. To the founders, this is their life. They probably might not get another shot. This is their baby, in a very literal sense. And our goal is to find those great opportunities that maybe don't have that next round available, and where we think our operational expertise can help them figure out how to get back on the growth curve and provide them the capital so their products can serve society. So we're directly aligned with founders, but at that stage. So when the founder just has their new idea, that's not where Rex is really getting involved. It's more later on in that process, and they're not able to get that scaling capital and the scaling expertise, et cetera. That's where we're trying to play.
That's really interesting from kind of like an investment thesis point of view, right? Because some of the other deep tech funds that I know, they like being the first check.
Correct.
Like it's a similar thing. They're betting on kind of like what I would almost go and say.
Right out of the R&D center, et cetera.
Yeah. It's like it's that subject matter expert. They've got into some crazy niche. You go and take a look at this large TAM, and you're like, oh man, if this hits, we're going to go and get like 200x return or something like that, right? But you're at a later stage. You're at the like almost like resuscitate or enable it to bring things to life. So how does that change the dynamics that is there with previous investors? So you talked about, maybe there's a founder exit, but is there also like an investor exit that you should be considering as well?
In our experience, everybody wants to make money, but these types of founders, they're more driven by getting their product, their invention, their dream into the market. That's what's the key motivation, and making money. So we want to make sure that they're motivated to make money, they're motivated to stay with the company, et cetera, as far as their ownership structure, after our investment. But that's their motivation. And we're also finding in the history of the investments, there might have been seed and angel investors, then a Series A, et cetera. When we come in and talk to the company, and it may be a flat round, maybe an up round, maybe a down round. The seed and angel investors, usually these companies, when they get to that point, they're winners. They're the ones that got the VC money, et cetera. So they want to see it continue. So they're supportive of what we're doing. The VCs, it's a little tougher discussion, frankly. Not only because of the economics and the terms, but also, is it better for their reputation to just take a 0? Versus taking a 1.5 or something like that. So economically, our proposal may be a better long-term value for them.
Yeah.
But so that's always tricky and difficult. But it's something we've got to deal with. It's part of the reality. And frankly, the way we view it is if there's more of what we do and more people that do what we do, and that there's kind of this unrecognized void that we can help address, and maybe others do as well, it may make some VCs slightly change their attitude versus what we encounter oftentimes.
So I want to kind of build a little bit on the philosophy that you are bringing to this, because you talked about the relationship with Stanford. It looks like it was a catalyst from the
Not
research
Stanford, but Stanford Research Institute.
Stanford Research Institute. Thank you. No, appreciate that correction. Are you, because deep tech can be very broad, right? Look, AI was a deep tech space for a very long time. Now it's like the sexiest thing on the planet. Is there a specific domain that is there for Rex Capital that you are in? Like, are you in like chemical sciences? Are you looking at the revisiting of hardware that is seeing like a new resurgence? What would be your kind of sweet spot in deep tech that people that are listening to this would want to say, hey, I myself, or I know a colleague or a friend who has started a company, should talk to Rex?
Yeah, those are listed specifically on our website, which is rex-cap.com. So things related to semiconductors and advanced electronics, we have a lot of experience on that. See, obviously, a lot of changes and continuous evolution, so a lot of opportunity. Advanced materials, We're very interested in that. Our team has got a lot of background in that and commercializing those things. Chemistry is sort of related to advanced materials. There's some sustainability, environmental things that we're interested in, that we have experience with. So I'm probably forgetting some of what we're.
No, I think that's a good basis, because it brings me to another question, right? Because you're talking about industries that have, I think, a long track record of invention and ebbs and flows that is there. One thing that is a commonality in all these spaces is the balancing act between going and utilizing patents that are there to protect the research, or increasingly around trade secrets. So from your perspective, what should people go and consider around how they protect their investments, not just from going and getting capital to bring them to life, but what are other considerations that are there?
Yeah, so patents are a central part of our strategy, but I'll come back around to your question because it's an interesting question. So patents are essential, intellectual property is a central part of our strategy. Within our team, we have experience in creating value just out of IP as an asset class, so to speak, et cetera. Frankly, it can be viewed as a alternative source of value if things don't work out with the company. And the companies we're investing in have a lot of that. But so that's interesting. And from that perspective, it's got to be a very broad family of patents to make it have any real potential value versus just a patent. And there's a lot of strategy involved in how those are developed. But the benefit of a startup company using a patent to go after some big company that's done something, I mean, that's a long and hard road. Having a strong patent portfolio to negotiate against a big company, that can be beneficial. Having strong patent portfolios in an exit is critical and central, because then when it gets into the big guys' hands, then they can really be of some value. But to your point on trade secrets, I mean, we're very concerned about some of the secret sauce being secret and not exposed through the patent process in other ways, and that's a delicate balance of how that plays out. But there always has to be something that's proprietary and secret.
I love what you're saying there, because I want to build on that, Kurt, because an interesting thing that is there, and look, I've been in and around the IP domain, the valuation domain, for a long time professionally, and one of the things that I'm finding fascinating is this increasing, I would say almost like a marriage between going and patenting portions of the overall picture, but then leaving the way the two patents or the patent family ties together into a trade secret, right?
Right.
How do you think that is a competitive advantage or a necessary requirement for a deep tech company? Because you really are typically at the fringes of expanding an existing horizon, i.e. semiconductors or applied materials, or going into a whole new realm, as the AI reference we made earlier.
Your question was kind of how is that like competitive?
How critical is it to go
I would view it as more like, how do I say this? Like theoretically, the preference might be zero patents and all trade secrets, but there have to be some patents. So it's like how far do you take the patents? How much do you think you need to patent to make it viable as an acquisition? How much do you need to take the patents to fundamentally create some protection? How much do you need to take the patents so that if some lawsuits come up, there is some ammunition you have? But that's I would view it more like that. How far do you have to take it? But you still need to maintain some of that primary secrets inside the core organization. And that there again comes back to the importance of the founders, their motivation, their incentive, et cetera. That continually making sure that they're excited about getting up every day and coming to work. And it might not have been fun times they've been through if they come to talk to us. Not every situation we look at is deep tech. Every situation we look at, we have to feel we can add value operationally, and the team has to want us to add value. We never want to force ourselves on them, et cetera. Not everything we look at has this sort of, installed flavor to it. But those that do, it's generally not been fun past couple months or years for the founders, we need to make sure they are excited about waking up in the morning and coming to work.
It's so interesting what you talk about, that also like kind of like that peace of mind and assurance, right? Like it's how you are as an investor for the founder, I think, is almost as critical as the capital that is coming in. You know, I've gone and talked to other investors or acquirers who are just like, look, we are very hands-on. We go in, they're almost like a fractional operator that's in there, not just somebody who kind of check. Versus, I think what you're alluding to is in deep tech, it's a different type of balance. It's a question of what's the skill set that the founders need.
Yeah, and the other way we think about it is that at least the limited number of things we're looking at, the thing, and that we have previously looked at, there's generally a global class technical expertise in the company, that they allowed it to get to where it is. And it generally a strong understanding of a market need that they can address. And so that's allowed them to get, some funding and develop a business, et cetera. In our perspective, the number of decisions that have to be made kind of once you start building on the revenue base and dealing with customers grows exponentially. And, the company may be able to start servicing one or two customers and et cetera, but that number of decisions that have to be made is just growing so rapidly. We're looking for managers that realize, we could use your help. We could use your help in thinking through these. We could use your help in upskilling some of our team. We could use your help in making some of these decisions. So that's where we are. So that we're not, again, I repeat what I said a minute ago, we never want to force ourselves onto these people. We never want to say, hey, you got to take our advice. But if, they need to want us for us to feel comfortable about getting involved with it.
And that's that matching element that's there. I actually want to bring you back a little bit to your private equity background.
Sure.
One of the things that I see a divide on, depending on who I talk to, is this whole thesis of if you start a company, you should have an exit plan from day one. And yes, you're going to go and tweak it, but you should have an exit in sight. Now, in private equity, it's pretty set, right? You're usually in like a 7-year fund, or maybe it's shorter, maybe it's a bit longer. So you kind of know it's like, okay, we bought this thing, we're already going to go and figure out there's an exit mindset. How do you balance that in deep tech where you might not even have a product figured out yet? You might still be at that research validation stage. How do you balance an exit?
Not when we get to it. So just to be clear,
okay.
for us, the way we characterize it is that there's the technology risk, there's a product development risk, and then there's everything after that. There's the go-to-market development, there's the commercialization plan, there's the operational scale-up. The companies we're looking at, they've already crossed off the risk of the product, the technology, et cetera.
So there is an exit.
They need help in commercializing and scaling, et cetera. But on your questions about exit, in my days in the private equity world, in the larger scale, at the time, larger scale, and then the small to mid-sized scale, I was also involved in. You went into it with generally some understanding of who's going to want to buy it. It's never going to work out right like you planned, generally, but you knew that there was someone that would buy it. These days, it's more I generate cash flow, another PE firm's going to buy that cash flow. In my era, so to speak, a number of years ago in the PE world, that wasn't such a prominent exit scenario. It was more strategic. You knew what the category was before you went into it. That's similar to the things we're investing in now. You never know where it's going to end up. We're never thinking things are going to go public, et cetera, although I'm involved in an offering right now that's hopefully going to close in about 2 months. You know who the strategics are that if this works, they're going to have a big interest in it. That's kind of a precondition, and everyone understands that.
That's really helpful. I appreciate that counsel, and I think it's what you're also really pointing to on this call for me is having the founders understand how the investors or the funds that they're speaking to also contextualize themselves in the life cycle of taking a company from inception all the way to its next stage, post-founder or both, et cetera. And I think
many, like you said earlier, many deep tech companies, want to be the first check and participate all the way through to the exit. I mean, absolutely, and maybe a smaller percentage of each round as things go on. But there's also many investors that are staged, we are the seed, we are the A, and I think founders need to realize, well, which audience are they talking to? Because they're all having a little bit different perspective and also the level of involvement. many investors are just sort of hearing, the earlier stage, they're hearing about a concept. Oh, that sounds exciting. Here's some money, so to speak. Kind of that A, B. It's much more detailed look into it. And I also think as it gets to later stages, it's more, like in the PE, it's more transaction specific versus company specific negotiations and needs and et cetera. So, which audience are they talking to? And as you go up that spectrum, it's different what they're focused on.
That's really helpful. I so appreciate that. Kurt, I have one final question for you. One thing I've kind of picked up from my career is that I sometimes go back to like a phrase or a quote or a statement that I'm just like, wow, this really kind of helps me recontextualize. One of my favorites is Charlie Munger's, show me the incentive, I'll show you the outcome. And It really helps me kind of unpack what might be really going on when things look too good or don't look as good as you think they should be. What's one for you that you've kind of gone and realized has given you an advantage in the moment, or has given you that pause when you needed it, or that different angle? What comes to mind?
You hit me with that, and nothing really. I don't have a favorite quote like that. What comes to mind is what my dad would always say: "Life isn't a bowl of cherries. It's always hard out there." But anyways, that's not.
But it's great. Look, I got to go and have at least something that throws the people off that are on this show to kind of bring out the personality. Kurt, I so appreciate this. I really love how you've kind of contextualized the balancing act between a fund that is looking to go and make a difference with the founders, but also being at the right stage at the right time, right? About when does the founder need you? When are you able to add the most value? And I think my takeaway from this session is that founders also have to understand that a no isn't because of your business model. It may just not be a no because of the fit between what the fund is trying to achieve and what the founder is trying to achieve. So thank you for your wisdom.
Yeah, I
and
think
counsel
that would
today.
be I think that's a really important point is to, anytime you're asking for anything, trying to sell a hamburger, trying to raise $10 million, trying to do whatever, if it's a no, you take it personally. It's never, like you just said, I mean, it's no, I'm looking at 100 deals and there's 2 that really make sense to me, or we're just not interested in that particular technology, or this stage of the business doesn't fit us, et cetera. It's not personal. You just have to keep plugging. Steve Schwartzman, talks about it when he was starting Blackstone. I can't remember the exact number. It was 60 or 70 or et cetera. Investors he talked to all said no. And then he finally got one in the Mellon family, and the rest.
And look at him now.
Yeah. So I mean, it's persistence. A lot of people. You mentioned Munger, and Buffett talks a lot about. It's the getting up and continue going. I mean, it's fun. I enjoy what I do, but it's there's always days where there's issues, and you just got to keep going, one step at a time.
Kurt, thank you so much for joining us on Raise and Exit.
Thank you. I've enjoyed it.
And look forward to having people reach out to you as a result of our chat today.
Thanks a lot.
It was a privilege to be the first podcast that hosted Kurt Buseck on Raise and Exit. And what I thought was just fascinating was to go and get the experience of somebody who's been all across the investment landscape, from private equity to venture to deep tech, and had decades of experience, and actually brought together an organization where everybody has skin in the game and has figured out a very, very key niche in a portion of venture capital which doesn't have enough pizzazz in the moment for a lot of industry coverage or media coverage, and that's the scaling side of deep tech. And what I thought was very interesting in what Kurt kind of conveyed is it doesn't matter where you start as a deep tech company. You want to be going and taking a look at what your exit pathways that are there for your business. And it's not just from the basis of, you need to be able to figure out how to sell your company. It's that you need to be able to understand your exit pathways for how you're going to go and raise money for your company. Keep in mind, when you're going and pursuing deep tech, you're playing the extra long game. You're playing the 10 to 15, maybe 20-year game where you're trying to go ahead by multiple generations potentially of the underlying technology that's there. So for Kurt to kind of go and convey that thinking needs to be there, and you need to be kind of thinking about that as part of your strategic plan, as part of your review with your investors, constantly looking for signal as to what's going and driving value, because you may have gone and looked out on a 15 to 20-year time frame when you started your deep tech entity, But maybe time comes at you faster, similar to how we've gone and seen with AI and certain other hardware technologies that have recently been happening. So you always want to know what's the criteria for exit. And it kind of goes to what I espouse in the work that we do, which is always be ready to have a transaction, whether it's to raise capital because you're in the right place at the right time, because you knew to be in the right place at the right time, or to be able to have an opportune exit because ultimately that is something that you want to go and do. And it doesn't need to be a full exit when you're on a beach the next day, but it might be an exit in partnership with a strategic, where you're going to kind of see your vision through the capital and distribution that they're able to go and provide. So hopefully that gives you some context on how to think through this and really go back and look at the deep thoughtfulness that Kurt went and brought. And I invite you to reach out to him if you see that he's a fit for what you're going and building. Cheers.